Hello, everyone. In this international finance lesson, I will cover managing FX risk. Managing foreign exchange risk involves identifying your exposure to currency fluctuations and using strategies to reduce potential losses due to unfavorable exchange rate movements. This is especially important for businesses involved in international trade, investors with foreign assets, or anyone dealing in multiple currencies. Let's now consider the types of FX risk. There are three types of FX risks, and understanding what kind of risk you are exposed to is the first step in effectively managing the risk. The first type of FX risk we'll look at is transaction risk. This is the risk from exchange rate changes between the contract date and payment date. Transaction risk is common in import or export deals, as well as overseas payments. Next, let's consider translation risk. Now, translation risk affects multinational companies when they consolidate via foreign financial statements. Note that multinationals typically would have ownership interest or equity interest in these foreign subsidiaries, right? And in preparing the consolidated financial statement for the multinational, one needs to account for these equity interests in these foreign subsidiaries, which are in foreign currency. And it will mean that those equity interests, when converted into the primary currency of the multinational, would expose the multinational to FX risk. And the third type of FX risk we'll talk about is economic risk, which is pretty much operating risk. So this is long-term risk to a company's value due to exchange rate shifts that affects the competitiveness of the company or the operating costs of the company. We will now consider key strategies to manage FX risk. There are three key strategies. The first is natural hedging. That's using operational strategies to manage the FX risk. And then we have internal risk management practices. And third, the use of hedging with financial instruments. So let's now discuss natural hedging. Now, under natural hedging, we could use the matching of currency inflows and outflows as a strategy. Now, this strategy simply implies earning and spending money in the same foreign currency so that the company's net exposure to currency fluctuations is minimized or eliminated. Now, let's take note that matching currency inflows and outflows is a simple but powerful natural hedging technique used by businesses to reduce foreign exchange risk without using financial instruments like forwards or options. Another natural hedging strategy will be localizing operations. So within that strategy, we can have the manufacturer or source in the same country as the company's revenue stream. So we just simply manufacture or source in the same country as your revenue stream. And the third natural hedging strategy we'll look at is diversifying markets. Now, this would involve spreading exposure across different countries and currencies. We now look at internal risk management practices as a key strategy to managing FX risk. Now, within the internal risk management practices strategy, we can have the setting of FX policies. So an FX policy is a formal document that outlines a company as identification, assessment, monitoring, and mitigation of currency risks. So here, the company will outline how it's gonna identify, assess, monitor, and mitigate currency risks. It will also set rules, responsibilities, and procedures for managing foreign exchange exposures. The FX policy must define exposure limits, hedging percentages, and approval processes. So for example, we can have an FX policy document which would indicate that it is a policy of whatever the company's name is to identify and hedge a minimum of 80% of forecasted foreign currency exposures over the next 6 months using forward contracts. And the treasury team of the company will report FX exposure monthly, and all hedging activities must comply with, for example, IFRS 9 hedge accounting standards. Within the internal risk management practices, we can also have the use of multi-currency accounts. Multi-currency accounts allow a business to hold, send, and receive money in different currencies within the same bank account or banking platform. These accounts support natural hedging by minimizing the need to convert currencies and reducing exposure to foreign exchange risk. And within internal risk management practices, we can have the regular monitoring of exchange rates, especially around key transaction dates. And lastly, we can have the centralization of treasury management, and this will allow for better visibility and control. We will now consider hedging with financial instruments as a key strategy to managing FX risk. And we can use forward contracts. And with forward contracts, what is simply done is the locking in an exchange rate for a future date. So we lock the exchange rate at the present time for a future date. And it's also best known for, or rather, it is best for known future cash flow. So using forward contracts is best when we know the future cash flows. And next, we're going to look at future contracts. And futures are similar to forwards, but they are traded on the exchanges. And it's useful for standardized short-term hedges. Now, let's also bear in mind that the forward market, where forward contracts are traded, is essentially an OTC market, that's over-the-counter market, where the forward contract for purchase or sale of a foreign currency is tailor-made between the client and its international bank. The client buys or sells the contractual amount of the underlying asset from the bank at a maturity at the forward price. Now, on the other hand, a futures contract is an exchange-traded instrument with standardized features specifying contract size and delivery date. Futures contracts are marked to the market daily to reflect changes in the settlement price. No money changes hands until the maturity date of the contract, when delivery and receipt are typically made. Delivery is seldom made in a futures market. Rather, a reversing trade is made to close out a long or short position. Let's consider an example of hedging with a forward contract, and recall that forward contracts are best when we know the future cash flows, or pretty much they are best for situations where future cash flows are known. So in this example, a US-based company expects to receive 500,000 euros from a customer in Germany in 90 days. So the future cash flow is known. The unhedged risk is as follows. If the dollar to euro rate moves from 1.30 to 1.25, take note that the exchange rate moving from 1.30 to 1.25 means that the euro would have moved from $1.30 to $1.25, meaning that the euro is worth fewer dollars in the future. 1.25, meaning the euro would depreciate in that case. Now, the implication of that is the company, when the 500,000 euros are exchanged at 1.25, would receive fewer dollars. Now, with a forward contract, the US-based company can lock in the rate of 1.30 for the future, thereby guaranteeing the amount of $650,000 to be realized from the 500,000 euros. Let's now consider hedging with options. Options give the holder the right, but not an obligation, to buy or sell currency at a set rate. As a result, it offers flexibility and downside protection. So we can describe an option as a contract that gives the holder the right to buy or sell a given quantity of an asset. In this case, our focus is on currency options. So a given quantity of currency at a specified rate at some time in the future. Now, this is simply a right. So there is no obligation, and certainly there wouldn't be any enforcement of any obligation on the holder if the spot rate is more favorable than the option exercise rate. Again, if the spot rate, that's the spot exchange rate, is more favorable to the holder of the option as compared to the option exercise rate, there's no obligation to buy or sell the currency at the set rate within the option contract. Now, because the option owner does not have to exercise the option if it is to the holder's disadvantage, the option has a price or premium, whereas there's no price paid at inception to enter into a futures or forward contract. So that's a key difference between an options contract and futures or forwards. With the option, there's a price. Then that's the option premium that needs to be paid. Whereas with a forward or futures contract, there's no price at inception. So for example, a US firm expecting to receive euros from a customer could buy a put option on the euro. That's a right to sell the euro at a set price or a set exchange rate to hedge against the euro depreciating, which we considered in the prior example. When the euro depreciates, the dollar equivalent will be less. So to hedge that risk, a put option could be used by the US company. Let's now consider options in, out, or at the money. So when an option is in the money, the option is advantageous to the holder, and the holder gets to make a profit, quote unquote. If the option is at the money, it's pretty much break even. No profit or no loss to the holder. And when the option is out of the money, the holder of the option will lose if they go ahead and exercise the option. So it's not advantageous to the holder of the option. Now, the holder of the option is said to have gone long on the option. All right, again, the holder of the option will typically be referred to as going long on the option. And then the writer of the option, who is on the other side of the contract, is considered as the writer. Now, as far as the types of options, we have a call option, which is the right to buy foreign currency at a specified rate. So that will be the exercise price, E. Again, the call option gives the holder the right to buy foreign currency at a set rate, which is the exercise price, E. Now, at the future date, that's on the date of expiration of the option contract, when the option contract can be exercised in the spot market, the exchange rate will be referred to as S sub T. So that's the spot exchange rate at the future date when the option can be exercised. And then the option contract will specify a rate called E, that's the exercise price. Now, take note again that the call option is giving the holder the right to buy foreign currency at a set exercise price. Now, the general principle is that you want to buy low, right, at a lower price. That's advantageous to the holder of the call option. You want to buy at a lower price. So for that reason, when E, that's the exercise price, is lower than the spot exchange rate, the call option will be in the money. Now, on the flip side, for the put option, which gives the holder the right to sell foreign currency at a set exercise price, you want to sell at a higher price, right? That's advantageous to the holder of the put option. You want to sell at a higher price. So when E specified exchange rate in the option contract is higher than the spot exchange rate, we'll say the put option is trading in the money. And then on the flip side, the call option will be out of the money if the exercise price is higher than the spot exchange rate in the spot market at the expiration of the option. So for that matter, exercising the option and buying the foreign currency at a higher price as specified in the option contract compared to the spot price, it's not profitable, it's not advantageous to the holder of the call option. So the option will be out of the money. And then for the put option, when the exercise price is lower than the spot exchange rate at the future date when the option expires, S sub T, the put option is out of the money. Let's now consider hedging with currency swaps. A currency swap is essentially an agreement to exchange principal and interest payments in different currencies. And the primary functions of currency swaps are, number one, to create cheaper funds or debt. So a swap can reduce the overall cost of borrowing. Second primary function is to hedge long-term currency exposures and reduce an organization's financial risk. So let's look at an example of a currency swap. So as indicated earlier, a currency swap can be used to hedge FX volatility of a foreign currency loan, right, or a bond issue. So a Canadian company has issued bonds in US dollars. Let's assume $10 million. And this bond issue requires periodic interest payments and principal payment in US dollars. The FX risk can be hedged by entering into a currency swap contract with a counterparty such as a bank for the equivalent 14 million Canadian dollars, with each party paying the interest on the amount received from the currency swap. At maturity, the principal amount swapped may be returned to each party. So as a result of this swap, the Canadian company remits the $10 million proceeds from the bond issue to the bank, and this is 10 million US dollars. So it remits that from the bond issue to the bank while receiving 14 million Canadian dollars. Now, at maturity, the 10 million US dollars is returned to the bank, which the Canadian company uses to repay bondholders. Moreover, under the currency swap contract, the Canadian company is required to make interest payments in Canadian dollars, implying there is no need to exchange Canadian dollars to US dollars for interest payments. Therefore, the FX risk is effectively hedged. So the currency swap protects both interest payments and principal repayment from FX volatility. So let's consider some important points about hedging. Number one, hedging reduces uncertainty. It does not eliminate all risk. Number two, over-hedging can be costly if rates move in your favor. And then instruments like options will cost premiums, while forwards and futures typically don't have any price at inception, so they don't cost any premiums. And this brings us to the end of this international finance lesson on the managing of FX risk. I hope you've enjoyed this lesson, and I look forward to taking a deeper dive into other international finance topics with you in subsequent lessons.